Would you rather take $1 million right now or 1 cent that doubles every day for 30 days? Most people see $1 million and think, done, easy. But here's the crazy part. That 1 cent doubling every day actually beats $1 million if you have patience. Let me explain the math. Day one, 1 cent. Day two, 2 cents. Day three, 4 cents. Not a big number, right? Day 20, you have $5,242.88. Now we're getting somewhere. And by day 30, that tiny penny has grown to $5,368,709.12, all from starting with that single cent. That is the magic of exponential growth. It starts small and slow, but it accelerates insanely fast once it takes off. And most people don't understand how powerful doubling really is. Instead of learning how to play hot cross buns on a recorder, this is the sort of stuff that we should be taught in school, but isn't. Today, we're diving into investing. What is it? Why does it matter? And how can you start building wealth with confidence? Whether you're completely new or just want to grow your money smarter, this episode will give you the tools and mindset to take control of your financial future. So let's get started. Now, I am going to preface by saying I am not a financial advisor, and all of the information I will be giving you today is just so you can understand a little bit about how the stock market works and possibly apply some of the rules and principles to your life to help you learn how to create additional wealth. The headlines are very overwhelming right now. One expert says invest as soon as possible. Another insists that gold is the safe bet. You're told to stash away a fixed percentage of your income for retirement. Then suddenly there's a warning to steer clear of tech stocks because the AI bubble is about to burst. So what advice can you really trust? And more importantly, what's the smartest move for you? I didn't figure out how to grow my money until later on in life. And once I did, everything changed. So let me simplify this for you. I'm going to cut through the jargon and the noise and tell you exactly what you need to focus on, not just to protect your finances, but to actually put yourself in a position to win long term. Let's start with the basics. What is investing really? And why does it matter so much? In simple terms, investing is just putting your money to work so it can grow. That's it. But here's the real question. Why do we need to make our money grow in the first place? First, there's inflation. Over time, inflation quietly erodes the value of your cash. Prices go up, but the money sitting in your bank account doesn't always grow with them. So the amount you have today will likely buy you less in a few years. Doing nothing with your money can feel safe, but it's a slow and steady loss of purchasing power. Investing is one of the simplest and most effective ways to build real wealth. We live in an economy that rewards ownership. People who own assets like properties, stocks, or businesses tend to grow their wealth far faster than those who rely solely on a paycheck. Earning income is important, but owning assets is what truly builds you long-term financial freedom. If you think about it, someone who bought a home years ago has likely seen its value double or even more. Someone who consistently invested in the stock market has historically earned average returns of around 7 to 10% per year over the long term when done wisely. But wages, they've grown much more slowly and have often struggled just to keep pace with inflation. So if you're tired of feeling like you're stuck in the cycle of earn, spend, constantly working but never truly getting ahead, it's time to shift your approach. The key is learning how the system works and using it to your advantage, and it all starts with investing. Now that we've talked about why investing matters, let's break down what's really happening behind the scenes. Because the stock market is something almost everyone has heard of, but not many people truly understand. When you buy a share of a company, you're actually purchasing a small ownership stake in that business. For example, if you buy a share of Apple, you own a tiny piece of that company. You're essentially saying, I believe this company will continue to grow, innovate, and become more valuable over time. And I want to benefit from that growth. When a company decides to sell shares to the public, those shares become available on the stock market. Think of the stock market as a large marketplace where people buy and sell ownership stakes in thousands of companies. The price of those shares move up and down throughout the day based on supply and demand. In other words, what buyers and sellers believe these companies are worth at any given moment. Now, there are two ways to make money when you invest in stock. The first is through deferred capital gains. That simply means you buy a stock at one price and later sell it at a higher price. If you buy a share of Tesla Incorporated and its price rises over the next year, you can sell it for more than you paid. The difference between what you paid and what you sold it for is your profit. The second way is through dividends. Some companies share a portion of their profits with shareholders by paying them regularly, often quarterly, sometimes annually. It's essentially the company's way of rewarding you for being an owner and encouraging you to stay invested. Now, you might be wondering, what should I actually invest in? Should I just pick one company like Tesla? You could, but that approach carries a lot of risk. Even the most successful companies can struggle or fall. Take Nokia, for example. Years ago, it dominated the mobile phone market, but technology shifted quickly. Competitors innovated faster, and within a few years, the landscape looked completely different. The reality is, even if you spend hours reading financial reports and analyzing companies, it's extremely difficult to consistently predict which individual businesses will win long term. That's why many successful investors don't try to pick individual winners. Instead, they buy a broad mix of companies all at once through something called an index fund. An index fund is essentially a basket of hundreds, sometimes thousands of stocks designed to track the overall market. For example, you can invest in a fund that tracks the S&P 500, which includes 500 of the largest companies in the US, such as Apple, Microsoft, Amazon, Alphabet Incorporated, and Tesla, among many others. Instead of putting all your eggs in one basket, you spread your investment across hundreds of businesses and dozens of industries: tech, healthcare, energy, finance, consumer goods, and more. If some companies struggle while others thrive, you will still benefit from the long-term growth of the market. Now, you might look at the S&P 500 and think, why not just invest in the top performing companies? In recent years, a small group often referred as the Mag 7, including Apple, Amazon, Microsoft, Alphabet, Meta, Tesla, and Nvidia, has driven much of that market's growth. But leadership in the market changes over time. What's dominant today may not lead tomorrow. Diversification through an index fund helps reduce the risk of betting too heavily while participating in long-term market growth. Now, I understand the temptation to focus on just big winners. They've delivered the strongest returns, so it feels logical to go all in on them. But history tells a different story. If you look at the S&P 500 over decades, the list of the largest companies has changed dramatically. Years ago, the market was dominated by names like IBM, Chevron, and AT&T. They were considered unstoppable at that time. Go back even further, you'll find companies like Sears, Xerox, Kodak among the dominant players. Investors assumed that they would continue leading their industries indefinitely. But leadership changes, industries evolve, and technology disrupts. Consumer behaviors also shift. The lesson is simple. There's no guarantee that today's market leaders will still be on top 10 years from now. Relying on a small handful of companies, no matter how strong they look today, increases your risk. That's why broad diversification matters. You simply can't predict which companies will dominate in the future. It's important to remember that also no single economy is guaranteed to lead forever. The US, for example, currently faces its own economic cycles and uncertainties due to the political environment. That's why it can be wise to invest beyond just one country and include companies from different regions around the world. No one knows which country, sector, or business will drive the next decade of growth. By owning a broad mix of global investments, you reduce the risk and create a more stable long-term strategy. Trust me, it's tempting to pick your favorite companies and build a portfolio around them, but in most cases, that approach earns you less over the long term than investing in diversified funds. To gain experience in the stock market and investing, you can gradually add more structure to your portfolio to potentially increase your returns. Now let's move into the next part, which is how to actually get started. You know what to invest in, but how do we begin? Here's the step-by-step approach. First, choose an investment platform. This is simply the website or app you'll use to buy and manage your investments. Wherever you live, make sure the platform is regulated, trustworthy, and transparent about fees. Even small fee differences can significantly impact your returns over time because of compounding. Before opening an account, review the types of accounts the platform offers. Some are general investment accounts where you may owe taxes on dividends or profits. Others may offer tax advantage options, depending on the country you live in, which can help you keep more of what you earn. Now, for my Canadian listeners, you're going to want to pay attention to this. If you're in Canada, you will likely have access to a tax-free savings account, which I think is the worst name of that account because it should be called tax-free investment account. And it's one of the best best tools for building wealth, and every person, depending on your province, over the age of 18 or 19 should have one. A TFSA is a registered investment account where your money grows tax-free. Let me repeat that. Your money grows tax-free. You don't pay tax on withdrawals, and you can hold investments like ETFs, stocks, mutual funds, and GICs inside of it. It's not just a savings account, it's an investment vehicle. Now, why is a TFSA so powerful? Well, let's say you invest in a global index ETF inside your TFSA, and if it grows over time, you have no capital gains tax, no tax on dividends, and no tax when you withdraw. That's huge for long-term compounding growth. Mind you do have to be a resident with a valid social insurance number, 18 or 19 depending on the province, and you can contribute up to a set annual dollar limit. For 2026, it was $7,000, and unused room carries forward indefinitely. So what does that mean? If you didn't contribute to your TFSA between 2009 and 2026, and you were at least 18 in 2009, your contribution limit could be $109,000. You can log into your CRA account and check your contribution room. You do not want to overcontribute to your TFSA because there is a penalty for that. But let's put things into perspective and why having a TFSA matters. If you contributed the maximum amounts to your TFSA every year since its inception in 2009, it would have been about $88,000 total by the end of 2023. And if it was invested into the S&P 500 index ETF, that portfolio would be worth over $200,000 by late 2023, assuming average annual return rates of around 10.2%. This represents more than double the original investment, entirely tax-free. Now let's talk a little bit about how to invest with automation and dollar cost averaging. One of the most powerful yet overlooked strategies is automation combined with dollar cost averaging. There is a saying, time in the market will always beat timing the market. And that's where it's important to understand how to use automation and dollar cost averaging in your investment strategy. One of the most powerful yet overlooked strategies is automation combined with dollar cost averaging. Instead of trying to time the market perfectly, set up monthly automatic investment amount, a fixed amount that is invested every month no matter what the market is doing. By investing consistently, you naturally buy more shares when prices are low and fewer shares when prices are high. Over time, this smooths out market fluctuations and reduces the stress of trying to time your investments perfectly. Dollar cost averaging helps you stay disciplined and benefit from long-term growth without worrying about short-term ups and downs. Now, what if things go wrong? It's normal to worry about market crashes and underperforming companies, but if you invest in diversified funds rather than individual stock, you're already better protected. Spreading your investment across many companies and asset types makes it easier to ride out turbulence. The truth is, the biggest risk isn't the market, it's your own emotions. Panic selling after hearing a scary scandal can lock in losses or cost you missed gains. Automating your investments and using dollar cost averaging removes that temptation, letting you stay invested and ride the market's long-term growth. So if you've been thinking about investing but weren't sure where to start, here's the simple roadmap. Choose diversified funds, invest consistently with automation, and take advantage of dollar cost averaging. It's how you build wealth steadily and with far less stress. And here's the part I wish someone told me earlier. You don't need to be brilliant. You don't need to predict the next NVIDIA. You don't need to time the next market crash. And you definitely don't need to understand every headline. What you need is a simple plan and the discipline to stick to it. Wealth isn't built in just one big dramatic move. It's built quietly, month over month, deposit after deposit, and year after year. It's built with you choosing ownership over consumption. Instead of buying clothes from Aritzia, maybe you want to buy Aritzia stock. Buy assets instead of just liabilities. Let compounding growth do the heavy lifting. The stock market will rise, it will fall, it will scare you, it will excite you, but over long periods of time, diversified ownership of productive companies has historically rewarded patience. And patience is something you can control. If you start today, even small, you put time on your side. If you automate, you remove emotion. And if you diversify globally, you reduce unnecessary risk. And that is it. It's not a get rich quick scheme. It's a get rich slowly, sleep at night strategy. And the difference between someone who builds wealth and someone who doesn't usually isn't intelligence, it's action. So go open that account, fund that TFSA, buy the diversified account, set up automation, then step back and let the system do the work for you. Because one day you'll look back, 5, 10, 20 years from now, and you will be grateful that you started this journey. I will be taking a deeper dive in areas around finance, investing, budgeting, and how you can learn more about money because it is a tool and resource we should all be utilizing. If you enjoyed today's episode, make sure you subscribe and continue the conversation over on Instagram or TikTok at Her Energy Unlocked podcast. I cannot wait to hear from you. Until next time, remember your energy is yours to reclaim, your story is yours to rewrite, and your next chapter is waiting. And I will see you in the next episode. Bye for now.